In 2006, a 44-story office tower in downtown St. Louis sold for $25 million. Last year, that same building sold for $3.6 million. That is not a typo. That is a 98% loss of value on a major commercial asset in a major American city. Now take that math and apply it to the $21 trillion commercial real estate market sitting on the balance sheets of American banks right now. The number you get is not a correction. It is not a cycle. It is a structural demolition of the collateral that holds the entire banking system together. And Wall Street built the machine that is doing the demolishing. This is not about a housing bubble popping the way it did in 2008. That was a consumer credit crisis dressed up in mortgage paper. What is happening right now is fundamentally different. It is a capital flow crisis, driven by institutional money-making calculated decisions to withdraw from the residential market entirely, leaving behind a frozen, distorted, and increasingly uninhabitable housing system for the bottom 80% of American earners. The forces that created this situation were not accidental. They were the logical outcome of a decade of zero interest rate policy, institutional financialization of single-family homes, and a Federal Reserve that kept rates near zero long enough for Wall Street to permanently rewire the ownership structure of the American housing market. By the time the Fed began hiking rates in March 2022, the damage was already done. The institutional landlords had their portfolios, the hedge funds had their leverage, and the median American family was locked out of home ownership at the exact moment the mortgage payment crossed $4,000 per month on a median-priced home. What Wall Street built between 2012 and 2022 was not a housing market. It was a yield extraction machine disguised as a neighborhood. And now that the interest rate environment has changed, that machine is beginning to malfunction in ways that are spreading into the residential market, the banking sector, the insurance industry, and the broader consumer economy simultaneously. To understand the mechanism, you have to go back to 2012 when the Federal Reserve's quantitative easing program was flooding the financial system with cheap capital. Institutional investors sitting on billions in low-yield cash needed a return. They found it in distressed single-family homes selling at post-crisis discounts. Invitation Homes, American Residential Properties, Progress Residential, and eventually Blackstone's real estate arm began purchasing single-family homes at scale, a practice that had never been done before in American real estate history. By 2022, institutional investors owned an estimated 574,000 single-family homes in the United States, with the highest concentrations in Sunbelt markets like Atlanta, Phoenix, Charlotte, Tampa, and Jacksonville. In Atlanta alone, institutional buyers accounted for over 30% of all single-family home purchases in certain quarters, according to data from CoreLogic. This was not passive investment. It was active market intervention. When institutional buyers compete alongside families for the same entry-level homes, they remove those homes from the ownership pipeline permanently. A family that buys a house builds equity and eventually moves up the housing ladder, freeing their starter home for the next family. An institutional buyer converts that home into a rental unit, generating quarterly returns for shareholders in perpetuity. The supply of purchasable starter homes does not just decline. It structurally contracts with no mechanism for recovery. What made this dynamic particularly destructive was the financing structure that Wall Street used to acquire these homes. Invitation Homes and its peers did not use traditional 30-year fixed mortgages. They used commercial real estate financing structures, specifically collateralized loan obligations and single-borrower commercial mortgage-backed securities that allowed them to leverage their portfolios at ratios that individual buyers could never access. At the peak of the cheap money era, institutional landlords were financing acquisitions at 70 to 80% loan-to-value ratios with interest rates below 3%, giving them a cost basis that made it mathematically impossible for an individual buyer paying 7% on a 30-year mortgage to compete on price. The game was rigged at the level of capital access, not at the level of desire or work ethic. This is the structural reality that the media rarely articulates clearly. The American family was not priced out of housing because they made bad choices. They were outgunned by entities with access to capital on terms that were never available to them. Now, the interest rate environment has completely reversed, and the institutional landlord model is cracking under the weight of its own leverage. The Federal Reserve raised the federal funds rate from near zero to a range of 5.25 to 5.5% between March 2022 and July 2023, the most aggressive tightening cycle in 4 decades. For institutional landlords with floating rate debt or debt maturing into this environment, the math has inverted. A portfolio financed at 3% and generating a 5% cap rate produced a healthy 200 basis point spread. The same portfolio financed at 7% and generating a 5% cap rate is now cash flow negative. Every day the portfolio operates, it is destroying capital. The rational institutional response to a cash flow negative portfolio is not to hold and pray. It is to exit. And that exit is now beginning to materialize in ways that are sending a specific set of signals through the housing data that most analysts are misreading as recovery. The National Association of Realtors reported a 20% year-over-year increase in housing inventory in key Sun Belt markets in early 2026. Analysts celebrated this as a normalization of supply, but a significant portion of that new inventory is not being generated by individual homeowners deciding to move. It is being generated by institutional portfolios quietly liquidating underperforming assets. This distinction matters enormously because institutional liquidation and organic seller supply behave very differently in the market. When an individual sells a home, they typically reinvest in another home, maintaining demand. When an institution liquidates a portfolio of 500 homes in Phoenix, all 500 hit the market as supply with no corresponding demand-side reinvestment. This asymmetric supply shock is one of the hidden drivers of price pressure in markets that are now seeing their first year-over-year price declines since 2012. And we are only in the early innings of this institutional unwind. Invitation Homes carries approximately $9.5 billion in debt on its balance sheet as of its most recent filings. American Homes 4. Rent carries another $4.7 billion. As a meaningful portion of that debt matures and refinances into a 7% environment over the next 24 months, the pressure to accelerate portfolio liquidation will intensify. The inventory wave that is just beginning is likely to grow significantly larger before it crests. But the Wall Street disruption of housing does not end with the single-family rental portfolio. The second and more structurally dangerous layer of this story is what happened in the commercial real estate market and how that crisis is now beginning to infect the regional banking system that provides 70% of all mortgage credit in the United States. Regional and community banks are the engine of residential mortgage lending in this country. They originate and hold loans in local markets, provide construction financing for new development, and supply the credit that allows builders to produce the entry-level homes that first-time buyers need. When those banks are impaired by losses in their commercial real estate portfolios, their capacity to originate residential mortgages contracts, credit tightens, builders cannot finance new projects, and the supply of new homes, already at historic lows relative to household formation, shrinks further. The commercial real estate impairment is a documented, measurable phenomenon. The Mortgage Bankers Association estimates that $929 billion in commercial real estate loans matured in 2024 alone, with another $957 billion maturing in 2025 and 2026. Office vacancy rates in major metropolitan areas have reached historic highs, with San Francisco at approximately 36% vacancy, Chicago at 24%, and New York's Midtown at 18%, according to CBRE research data. These are not vacant buildings that were poorly managed. They are vacant buildings experiencing a fundamental demand destruction driven by the permanent normalization of hybrid and remote work. McKinsey & Company's research estimates that hybrid work has permanently reduced office utilization in major cities by 25 to 30% from pre-pandemic levels. That demand does not come back. When a building is 36% vacant instead of 10% vacant, it does not generate enough rental income to service its debt. When it does not service its debt, the loan goes into default. When the loan defaults, the bank holding it must either foreclose and take a catastrophic write-down or extend the loan in the hope that conditions improve. The extend and pretend strategy has been the dominant response for the past 2 years. But extensions have limits. Regulators are tightening scrutiny. And the maturity wall is creating a forced reckoning that no extension can permanently defer. The consequence for the banking system is already appearing in the data. The Federal Deposit Insurance Corporation reported that the number of banks on its problem bank list rose to 66 in the third quarter of 2024, the highest level since 2015. Total unrealized losses across the banking system exceeded $500 billion as of mid-2024. New York Community Bancorp, which was seen as a healthy acquirer of failed institutions in 2023, disclosed in early 2024 that it needed to set aside dramatically higher loss reserves, specifically tied to commercial real estate exposure, sending its stock down over 60% in a matter of days. That single event was a preview of a dynamic that will repeat across dozens of smaller regional institutions over the next 18 to 24 months. When a regional bank in Phoenix or Charlotte or Atlanta is managing losses in its commercial loan book, it is simultaneously restricting new residential mortgage lending, tightening standards for construction loans, and reducing credit lines for the builders and developers who would otherwise add housing supply to a market already suffering from severe undersupply. This is the hidden mechanism by which Wall Street's commercial real estate implosion is directly connected to the housing affordability crisis that millions of American families are experiencing at the street level. It is not one story. It is two stories with a common cause and a shared consequence. The common cause is a decade of artificially suppressed interest rates that encourage leverage at every level of the real estate capital structure. The shared consequence is a market where institutional overleveraging is now generating a credit contraction that punishes the very buyers who never participated in the leverage game in the first place. The insurance market is the third rail of this system that is now conducting a lethal current through housing markets from Florida to California to Louisiana to Colorado. Major carriers State Farm, Allstate, and Farmers have withdrawn from or dramatically restricted new policy issuance in California, Florida, and Louisiana. State Farm announced in May 2023 that it would stop accepting new homeowner insurance applications in California, citing wildfire risk and construction costs. Farmers Insurance announced in July 2023 that it was capping its exposure in Florida and pulling back from several other states. This is not a weather story, though climate risk is the stated justification. It is a capital allocation story. Insurance companies are balance sheet managers. They hold policyholder premiums as reserves and invest those reserves in bonds and equities. When rising construction costs mean that rebuilding a $400,000 home requires $650,000 in materials and labor, and when climate-linked events are driving claims frequency beyond actuarial projections, the insurers face a simple arithmetic problem. The premiums they collected 5 years ago are insufficient to cover the claims they are receiving today. The financial consequence for homeowners is immediate and severe. In Florida, the average homeowner insurance premium reached $6,000 annually in 2024, more than double the national average, and in some coastal counties exceeding the principal and interest portion of the monthly mortgage payment itself. A buyer taking on a $300,000 mortgage at 7% pays approximately $1,996 per month in principal and interest. Add $500 in monthly insurance escrow, $400 in property taxes, and $150 in HOA fees, and the all-in housing cost exceeds $3,000 per month on a home that would have cost $1,800 per month to carry in 2019. This is not a marginal affordability strain, it is a structural affordability break, and it exists independent of whether home prices rise or fall, because the insurance and carrying cost components are now rising faster than home prices in the most affected markets. The feedback loop this creates in the housing market is mechanical. If a buyer cannot get insurance at a reasonable premium, they cannot close a mortgage. Federal guidelines require hazard insurance as a condition of loan origination. If insurance is unavailable or priced above what the buyer can absorb, the transaction simply does not close. The buyer does not buy, the seller does not sell, the market freezes. Frozen markets produce distorted price signals that make the housing affordability problem appear less severe than it actually is because the transactions that would reveal true price discovery are not occurring. This is part of why national median home price data continued to show nominal stability in late 2024, even as underlying market liquidity was deteriorating. The properties being transacted were not representative of the full market. They were a self-selected sample of the properties that could still be insured, financed, and closed. The rest of the market was functionally frozen. Harvard's Joint Center for Housing Studies published data in 2024 showing that housing cost burden, defined as spending more than 30% of gross income on housing, had reached 22.4 million renter households and 19.7 million homeowner households in the United States. Combined, over 42 million households are now technically housing cost burdened. The more severe category, households spending over 50% of income on housing, now encompasses 12.1 million renters. These are not abstract statistics. They are the financial profile of the fastest growing segment of the American consumer base. Households spending 50% of income on housing have nothing left for discretionary consumption, savings, or emergency reserves. They are one paycheck event away from a missed rent payment, one health incident away from a cascading financial default. This is not a description of poverty in the traditional sense. Many of these households have incomes between $50,000 and $80,000 per year. They are working people in the middle of the income distribution who are being systematically extracted by a housing system that Wall Street restructured to optimize for yield rather than access. The rental market that institutional investors built on the back of single-family home acquisitions is now delivering exactly the extraction dynamic that its critics predicted. A 2024 analysis by the National Housing Law Project found that in markets with the highest concentration of institutional single-family rentals, rent growth exceeded wage growth by an average of 14 percentage points over the prior 5 years. In Atlanta, where institutional ownership of single-family rentals is highest, rents on single-family homes increased 31% between 2019 and 2024, while median wages grew approximately 17%. The differential between rent inflation and wage growth is not a market inefficiency. It is the intended function of a portfolio managed to maximize shareholder returns. An institutional landlord with 80,000 homes raising rents 5% per year on each property generates $400 million in incremental annual revenue with no additional capital investment. The marginal cost of the rent increase is zero to the institution and total to the tenant. This is the precise mechanism by which wealth is transferred from renters to shareholders through the structure of the housing market. The political response to this situation has been largely performative. Federal legislation targeting institutional single-family landlords has been introduced in Congress multiple times, including the Stop Wall Street Landlords Act and the End Hedge Fund Control of American Homes Act, neither of which has moved through committee. State-level rent control measures have been implemented in California, Oregon, and New York, but they create supply distortions that reduce new construction by changing the risk-return calculation for developers. The policy toolkit available to governments facing a housing affordability crisis is genuinely constrained because the problem was created by capital flows operating within legal structures, and unwinding those structures requires either buying out institutional portfolios at market rates or regulatory changes that will face immediate legal challenge. What is actually beginning to restructure the market is not policy, but economics. The interest rate environment that made institutional single-family rental an attractive business model between 2012 and 2022 no longer exists. A strategy predicated on borrowing at 3% to acquire homes generating a 5% cap rate breaks when borrowing costs reach 7%. The business model does not pencil. And unlike a homeowner who can absorb an underwater mortgage because they need somewhere to live, an institutional investor has no such emotional attachment to the asset. When the math inverts, the rational actor sells. That selling pressure, combined with the commercial real estate losses hitting the regional banking system, is creating a convergent shock to the housing market that is unlike anything the system has experienced before because it is simultaneously hitting supply, credit, and insurance at the same time. The migration data is the most revealing indicator of where this pressure is transmitting through the economy. The Census Bureau's 2024 estimates showed continued net outflows from California, New York, and Illinois, with combined domestic outmigration from these three states exceeding 500,000 people in 2023. Florida, which was the largest net domestic migration destination during the pandemic era, saw that in-migration slowed dramatically in 2024 as insurance costs became the dominant barrier to home ownership for the middle-income buyers who had been driving the market. Texas continued to receive domestic migrants but began showing inventory buildups in Austin and Dallas markets as affordability constraints caught up with price appreciation. The Sunbelt boom thesis, which institutional capital had priced heavily into its acquisition strategy, is now meeting the structural reality of insurance costs, property tax reassessments, and the end of remote work migration as a volume driver. Austin, Texas represents perhaps the clearest case study in what happens when institutional capital, speculative home building, and migration assumptions collide with changed interest rate and affordability conditions. Median home prices in Austin rose over 70% between 2019 and 2022 as the city became the dominant destination for tech sector remote workers from California. Institutional investors, builders, and flippers all increased supply in response to the price signal. When the migration wave slowed in late 2022 and 2023 as tech companies began returning to office mandates and the Bay Area's price discount to Austin narrowed, the Austin market faced a supply overhang on top of the national affordability headwinds. By late 2024, Austin home prices had declined approximately 20% from their 2022 peak, according to Case-Shiller data, one of the largest corrections of any major metropolitan market. This was not a crash, but it was a structural repricing of assets that had been acquired by both institutional and individual buyers at valuations that required continued migration-driven demand to sustain. When that demand evaporated, the price discovery process was brutal and fast. The broader residential market is not Austin. Most markets still show nominal price stability because the lock-in effect of sub-3% mortgages is keeping existing homeowners from listing, constraining supply, and preventing price discovery. Approximately 62% of outstanding mortgages in the United States carry interest rates below 4% according to Federal Reserve data. Those homeowners face a severe financial penalty from selling. A family in a home with a $300,000 mortgage at 3.5% pays approximately $1,347 per month in principal and interest. The same family, if they sell and buy a comparable home with a $300,000 mortgage at 7%, pays $1,196 per month. That $650 per month payment increase represents over $7,800 per year in additional housing cost for the same nominal loan balance. This is the lock-in tax that is preventing market clearing. It is keeping millions of homes off the market that would otherwise be available to buyers, artificially constraining supply and sustaining prices at levels that the underlying affordability fundamentals cannot support. The resolution of this dynamic is not a mystery. It is a matter of timing and triggers. The 5 forces that break the lock-in and release supply into the market are death, divorce, debt, relocation for employment, and default. All 5 are time-dependent and independent of interest rate preferences. A household that needs to relocate for a job does not have the luxury of waiting for rates to fall. A homeowner who loses employment and cannot make mortgage payments cannot sustain the lock-in indefinitely. As the economic slowdown that the Conference Board's leading economic index has been signaling for multiple months moves from projection to reality, these forced sales will increase in volume. When forced sale volume crosses the threshold where it begins to overwhelm the suppressed buyer demand, the artificial floor under prices will give way. The transition from nominal stability to nominal decline does not require a dramatic trigger. It requires only a gradual increase in the ratio of motivated sellers to available buyers. That ratio is already moving in the direction of sellers in the most overextended markets. The final dimension of this crisis that is not being adequately priced into either market expectations or media coverage is the property tax mechanism. When home values inflate rapidly, local governments reassess properties upward and capture significantly higher tax revenue. Cook County in Illinois, encompassing Chicago, conducted reassessments in 2024 that resulted in average property tax increases of 18% on residential properties that had appreciated during the pandemic era. Similar reassessment cycles are underway or recently completed in Florida, Texas, California, and New York. For a homeowner with a fixed income or a household already spending 40% of gross income on housing, and $300 per month increase in property tax escrow is not a minor inconvenience. It is the difference between maintaining the mortgage and missing a payment. And unlike insurance costs, which can theoretically be shopped or contested, property taxes in most jurisdictions are non-negotiable and non-deferrable. They are a lien that supersedes the mortgage in the event of non-payment. The compounding of insurance cost increases and property tax reassessments onto a base of 7% mortgage rates is creating an affordability crisis that is not captured in any single metric but is felt acutely by every household attempting to maintain home ownership at the margins of qualification. What Wall Street built in the American housing market between 2010 and 2022 was a system optimized for capital extraction and institutionally efficient in its operation, but structurally incompatible with the social function that housing serves in a democratic society. Housing is not merely an asset class. It is the primary vehicle for wealth accumulation for the middle class, the geographic anchor for community formation, the collateral for small business lending, and the structural foundation of consumer spending through the wealth effect. When the ownership structure of housing is transformed from a distributed network of individual owners to a concentrated portfolio of institutional landlords, the system's vulnerability to capital flow disruptions increases dramatically. Individual homeowners make decisions based on life circumstances. Institutional investors make decisions based on return targets. When the return targets are not being met, the institutional response is coordinated and rapid. That coordination, at the scale of hundreds of thousands of units, creates shocks that the housing market's relatively thin liquidity cannot absorb smoothly. The data that will define the next 18 to 24 months in housing is already being generated in the pipeline. The MBA's weekly mortgage applications index has been running approximately 30% below its 2019 baseline for most of 2024, indicating suppressed transaction volume that will eventually translate into price discovery as carrying costs force decisions. Commercial real estate loan maturities will continue to generate regional bank stress that tightens residential mortgage credit availability. Insurance carrier retreats from high-risk markets will continue to expand geographically as catastrophic loss years continue to revise actuarial models upward. Property tax reassessment cycles will continue to compound the carrying cost burden on existing owners, and institutional portfolio liquidation will continue to add supply in Sunbelt markets, precisely as buyer demand in those markets is being constrained by affordability limits. None of these dynamics require a dramatic collapse event to produce significant market disruption. They are structural forces operating on multi-year timelines that compound in their effect as they interact with each other. The housing market does not need to crash to become dysfunctional. It only needs to remain at current price and rate levels for another 12 to 18 months, while carrying costs continue rising and credit continues tightening, for a broad consumer spending contraction to materialize from housing affordability destruction alone. The consumer represents 70% of American GDP. If the 42 million cost-burdened households that Harvard's research identifies are systematically reducing discretionary spending to maintain housing payments, the macroeconomic feedback is not a housing story anymore. It is the mechanism of the next recession. The process that Wall Street set in motion in the American housing market is not over. The institutional portfolios have not fully liquidated. The commercial real estate losses have not fully cleared the banking system. The insurance market has not stabilized. The property tax reassessments have not fully cycled through the escrow system. The lock-in effect has not yet broken under the weight of forced sales. Each of these dynamics is a chapter that is not finished being written. The conclusion of the story is not predetermined, but the direction of the current is clear to anyone watching the flow of capital, the structure of incentives, and the mathematics of carrying costs at current rates. The system is repricing. That repricing is structural, and the households and investors who understand the mechanism will be better positioned than those who are watching headlines and waiting for a single event to explain what took a decade to build. The next data points to watch are the Q1 2026 regional bank earnings reports and their loan loss reserve disclosures, the February and March 2026 existing home sales and inventory data from the National Association of Realtors, the delinquency rate trends in commercial mortgage-backed securities being reported by TREP, and the insurance premium renewal data coming from Florida and California markets where the repricing cycle is furthest advanced. These numbers will not tell a single dramatic story. They will tell a structural one. And structural stories unfold on their own timeline, indifferent to the calendar of market participants who prefer resolution to process. The process is still unfolding. The data will confirm it.